Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Martin Saenz. Martin is the managing partner of BeQuest Funds. Together with his business partner, Sean, Martin co-founded BeQuest Funds with the dual purpose of helping investors grow their wealth and helping mortgage borrowers stay in their homes. He has directly helped over thousands of families stay in their homes and countless more through the influence of his mentorship. And in just a minute, we're going to speak with Martin about note investing. But first, a quick reminder. If you like our show, CRE PN Radio, there's a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Martin. Welcome to CRE PN Radio.
Darren, thanks for having me on.
You bet. I'm really looking forward to our talk. But before we get started, if you could take just a minute and share a little bit about your background.
Sure. So, I started my career in corporate America, like most folks, after getting an MBA, and I just found that it wasn't a fit after a few years of working in corporate America. So my wife and I decided to start a government contracting company in 2005. And so after going through small business ownership and all the rigors behind that, we started buying commercial property in the DC area, which we were living in at the time, in 2009. And so really we just were rolling profits from the company into real estate. And this was after 3 grueling years of getting the business off the ground and bleeding money like nobody's business. So with that said, though, we found that small business ownership was very taxing, very demanding, hours wise, stress wise. So we sold that company in 2013. And a month after selling the business, I stumbled upon a note investor, and I was hooked ever since.
Awesome. Well, that's quite the background there. I mean, the fact that you tried different things, I love that, as opposed to just kind of you signed up for the corporate gig and never left, kind of thing, and also to get a flavor of the challenges of small business. Because even in real estate, and I'm sure even what you're doing now with notes, some of those lessons learned probably carry forward, do they not?
Oh, absolutely. I mean, just the imprint of being broke, staying broke. Whereas, because we ran hungry for many years, getting the business off the ground. So that's never left me. It's allowed me to appreciate what I have much more so now, and not take anything for granted, and live within my means, and be humble with, all that I have in my life. And I got all that from all the painstaking years of getting a business off the ground.
No, I hear you. Well, let's talk a little bit about note investing. Probably a great place to start is if you could just kind of describe, what is it?
Sure. So in the context of what we do, because there's various forms of note investing, if you take a homeowner that's looking to buy a home and they go to a bank and they apply for a mortgage, and it goes through underwriting, gets approved, and they go to the closing table and they sign a promissory note, which means they're going to borrow this money and they're going to pay it back given a certain set of terms. Now, they're also going to sign a mortgage or a deed of trust, which is going to tie that promise to the property in the form of collateral. So if they don't make their payments as promised, then the bank or lending institution will foreclose and take back that property. So what happens in 4% of the cases with bank originated mortgages is they go into default. Something happens in the homeowner's life, like a divorce or health or a job loss, whereby they stop making payments. And so what a bank will do after a certain set of time, for the most banks will bundle those defaulted mortgages into tranches and sell them into the secondary mortgage market at a discount. So the homeowner may owe $100,000 in principal balance, but the bank is just going to try to recoup some investment and get it off their books. So they might sell it for 20, 30,000 to a hedge fund in the secondary mortgage market. We operate a hedge fund on one side of the fence and have been for the past 9 years that buys these mortgages and works with the homeowner to create a payment plan that they can afford while keeping them in their home and making a profit for our company, of course. And so that's our whole business model. We take in mortgages, that are 4 or 5 years past due. And normally what we find is at this point, the homeowners have remarried or they've gotten their job back or their health back. Something has happened in their life whereby now we can go to the table with them, figure out what they can afford and give them a plan accordingly.
Got it. So I think the key to that whole opportunity sounds like it's based on the percentage discount you're getting up front, because the debt hasn't gone away. It's still intact, but you purchased it at a discount. If they owed 100 and you're buying for 20 or $30,000, is that not pretty much the model there? Is I mean, as far as the key to the opportunity?
Yeah, we look at it as a way of allowing us to provide concessions to the homeowner. So if someone owes 100,000 and we look through their financials and we determine that it makes sense if we lower the balance, it makes sense if we lower the interest rate, extend the terms, to help make it affordable for the homeowner, we're able to make certain concessions because we did pay for that mortgage at a discounted price point. And so it allows us to kind of work towards a win-win situation with the homeowner. And obviously, more profit the better if we can swing it. But here's the thing: if we hold the homeowner's feet to the fire, in full, and it's not a plan that they can afford, it's not going to be sustainable, and they're not going to make payments over a long period of time, which is absolutely our whole business model, is 20, 30-year cash flow streams.
No, it's beautiful. And you mentioned 4% of bank loans. That's the running average for forever, or is that like a recent period? Or I'm trying to think, just given the whole
Probably
08.
over like the past 10, 20 years. It's about
Okay.
it's a small percentage that goes into default.
Well, I mean, that makes I mean, again, it makes it clear why real estate's a good investment if that's the rate of failure. And that's residential loans, I'm assuming, correct?
Yes, that's correct.
Okay.
And we have the second side of the business, which is BeQuest Funds, which is an income fund so our hedge fund buys in distressed mortgages that's privately owned with my partner and myself. We have an income fund that's a 506C Reg D income fund for accredited investors, and that only buys in what we call reperforming mortgages. So these are bank originated. The homeowner, had a credit, they're an A type borrower, and they got into default, something happened, and then they got back on their feet and through a loan modification or a reinstatement, and they've been making their payments on time for 12 months, 24 months. And so they're back in good standing. And so BeQuest will buy that into the income fund.
Got it. And are you buying from the other fund, or are you buying out on the market, or how are you attracting or finding those?
Yeah, we're primarily buying from other hedge funds that operate the same business model as ours. We really don't want to tap on our own reserve because we use the reserve in the hedge fund to operate our whole operation from an expense standpoint. But if we have an abundance of capital in the fund's bank account, and we don't have a trade teed up, we may look to pull from our own stash.
Got it. So let me ask you a little bit about like the rate of return. My dad was a banker, and for most of my life, I didn't understand what he did until I went to go borrow money, and then became very clear. But my basic concept is that the bank borrows money at a discount, from Fannie or Freddie, mark it up a point or whatever, and then retail it. And they might get fees, for the transaction on top of that. But just the loan itself and the repayment, there's that spread that they're looking for over the life of the loan. Is that similar on your situation? Or, I mean, because if you're buying at a discount, I'm assuming you have a lot more opportunities or levers to kind of create a return.
So as the paper goes into defaulted status, majority of this paper was securitized at one point with Fannie, because all of it's underwritten with Fannie and Freddie underwriting guidelines, and so it goes into securitization with most lenders, and then but once it goes into default, it gets kicked out of the securitized bucket. In some cases, there is additional collateral reserve requirements placed upon the bank to hold defaulted paper, so it's just not good business for them. And so they'll bundle it up. Once they sell it to the secondary mortgage market, it's out of any kind of securitized tranche. So it's not Fannie and Freddie government sponsored mortgages. That's not applicable in our case.
Got it. But when you take them in, or whether it be in the your original fund or the BeQuest, again, how much capital, I mean, does it take to start one of these funds? I mean, to be a player buying from banks in their defaulted mortgage, how big of a fund or a checkbook do you need in order to be a participant in that?
Well, checkbook is just one of the factors of what it takes to run a successful fund. We've been doing this for the past 9 years, so I can kind of speak to regulation, compliance, licensing, capital reserves. The list goes on in terms of the risks out there. There's less inventory out there in the open market than there was before. So to answer your question, it's much more than just an amount of capital. There's a whole risk element to running our operation. We have people full-time on compliance. We have attorneys that keep us in compliance. We have licensed servicers that keep us in compliance, and we carry various licensing across the United States. So there's a lot to kind of maintain the operation from that standpoint to keep you out of trouble. But then there's a whole other component about building relationships with other hedge funds so that you can have an ongoing supply of deal flow, as well as having the capabilities to run due diligence on large portfolios and managing those portfolios. We have a whole team of asset managers. So what do you do once you buy the mortgages? You have to go and convert them from a non-performing state into a performing state. And that's the whole asset management approach.
Gotcha. And just that process, you get a portfolio of non-performing loans. What's a typical timeline for you to get them, performing?
Yeah, so we like to look at a 2-year time point to fully convert or work out all the notes in any particular buy. Obviously, it depends on the size of the pool and the states that the notes are held in, because each state has its own foreclosure requirement and various legal steps that we have to take to work out these mortgages. So it really depends, but we just look on average 2 years.
Got it. So in 2 years, you've worked through the cost of acquiring. The borrower is now paying as agreed, and now you have a potential deal if you wanted to sell it, somewhere else or just retain it. But it's performing at that point. Is that what I'm hearing?
So if you buy 100 mortgages, you might have 10 or 15 that start performing out of the gate. And then you might have another 20 to 30 that start performing at the 6-month point. And then, another batch at the 8-month point, another batch at the 15-month point, and some ones lagging towards the second year point. So as it depends on the effectiveness, or actually it depends on the quality of your due diligence to know that you bought notes that were, high quality, that resolutions can be had. And then, having all the asset management approaches in place to connect with the homeowner and work out a resolution to help keep them in their home. So based on how effective you are in those two areas will determine, how soon you can convert that pool. But the beauty of it is that, and this is why we created BeQuest Funds 2 years ago. My partner and I just own the hedge fund privately, just ourselves. So we don't have any investors in that. And so about 2 years ago, we had just thought, I have 3 books written on the note industry. So I have people reaching out all the time. And I just, we came to the conclusion like, hey, we need to open this up. People don't want to necessarily start a note business because of all the requirements, but they want to be a part of the profits. So, but with that income fund, when we buy a pool of mortgages, they're performing from day one. We're receiving cash flow from day one.
Got it. And what kind of a rate of return does that opportunity present in the note fund?
Yes. So it's there's an 8% annual preferred return that pays monthly. And there's a 9% annual return that pays monthly. The 9% carries a 4-year lock-in period, and the 8% carries a 1-year lock-in period. So depending on liquidity needs of that individual.
And I know you said accredited investors only. What's the minimum investment for somebody?
Sure. So minimum is 50,000 and the maximum's $1 million. And most people come in for about 200 is what we normally see on average.
Gotcha.
But it's a very boring, we like to call it a very boring fund because it's just boring, predictable income. There's people that I talk to investors daily because I run the investor relations side of the business. And some people, oh, I need 14%. I'm like, great, you should go for it. There's always risk associated with higher returns. There's something that you need to kind of, if you can manage the risks, great. And we could be a diversification tool. But if you're looking for just steady, boring money ACH'd into your account, where it's a good option.
Right. So as far as the first things, you have to be an accredited investor. The funds, I know I've talked with other people about different opportunities, and I know that like with syndications and all these kinds of things, there's if you were to put just your own cash in the deal, that's a very clean deal. I know sometimes people are looking about moving around some retirement funds. Is that an option for somebody if they had a 401k and they, it's self-directed now and they wanted to put some money in? Is there any resistance or reasons why they could not put their money in a one of your funds or BeQuest funds?
Yes. So probably about 45% of the money in our fund is, and it's a $50 million fund, comes from IRAs, self-directed IRAs. So a good majority of the money, or a good portion of the money in our portfolio, comes from self-directed IRA money. And most of those folks come in at the 9% because they're not looking to pull money out anytime soon. I would just add that, kind of to your initial point you kind of touched on. When my partner and I, Sean, launched the fund, we decided that we wanted to put our own money into to just get it kicked off. So we put about 1.3 in of our own money, and that was really important because for us to be able to ask anyone else to put their money, we wanted to show that we had our own money in there. I know there's a lot of investments that that kind of work. The operators really don't have any skin in the game, so to speak.
Yeah, I'm always happy to hear that the operators have some skin in, as opposed to nope, nothing.
Yeah.
So on a fund, when you're investing in a fund, I mean, a lot of times we talk in on this podcast about the tax benefits of investing in real estate. If you're directly investing, you have the opportunities for depreciation and interest write-off. I'm assuming, and correct me if I'm wrong, investing in a fund where you're doing notes, you're not necessarily taking title to any of these properties, so there wouldn't be any kind of depreciation, nor would there be any kind of interest write-off, because you're now the bank, you're making interest. Am I reading that right?
That's correct. I do have a, CPA opinion letter and sample K1. If anyone wants to see, that they can shoot me an email. The one savings we do have is a portion of our income is derived as capital gains income. So we pass that portion on to each individual investor. So if our overall income, 25% of our overall income came as a capital gains, earnings, then we would pass down that to the investor. So 25% of what they earned that year would be capital gains.
So you get the benefit of the lower tax rate on a capital gains, as opposed to just ordinary income.
Or if you're in with a Roth IRA, what does it matter? Or, some
Yeah, I was gonna
other.
say, I was just thinking in myself, I was like, wait a minute, this would be a pretty good opportunity to move some Roth funds over and do that. That'd be good. So, got it. So, quick question. So, you obviously you're in it now, and it's working. You've got it established in that. You mentioned that somebody had introduced it to you. What was that opportunity that you saw? Was it an individual property, or was it a fund, or what was it you saw?
Yeah. So I was going to my local RIA at the time, real estate club in the DC
Mhm.
area. And we had a presenter that was from a note education company. And they did their song and dance on Wednesday night. And I signed up for this satellite session on Saturday. And from that point, I was hooked. I'm thinking, I had been on the real estate side. So I kind of understand real estate. I'm still a landlord, so I still manage properties. So I get that side of the fence, but I was also looking for something that I can do remotely that gave me a little bit more freedom of time. So that was what was intriguing, buying mortgage notes, rehabbing them essentially like you would rehab a property, getting the homeowner back on track, keeping them in their home, developing 20, 30-year payment cash flow streams for yourself. And so I read every book I could get my hands on, and really just kind of learned by trial by fire. I bought some 10 notes that I shouldn't have bought, out of the gate, but I learned a lot from them.
Yeah. Well, experience, I think, is always one of the best teachers, period. Just like your small business experience, and if the 10 you bought worked beautifully, you'd never know what the problems might be. So that's
Right.
pretty powerful learning right
Yeah,
there. So,
what was interesting about the 10 is that I was focused initially out of the gate. I was focused on obtaining the property. So this was going to be a backdoor into acquiring property as a landlord, because that's all I really knew. So what I learned though is that when you focus all your due diligence efforts on obtaining the property back, then you're going to get what you focus on. right? Like kind of simple rule of thumb. And so what I ended up getting back was vacant properties, blighted properties, stripped out properties, and so on. And so I was having to kind of be a long distance landlord, kind of turning over these properties. But after I bought those 10, the first one I actually modified. So I got a deed in lieu. I didn't modify, I'm sorry. I got a deed in lieu. I resold it for half down, 18,000 down, and I took back an $18,000 note over 8 years at 7% interest. So that was my first experience of doing a seller financing note and earning cash flow. And that really changed my perspective, because I'm like, why am I trying to focus on the property when all I want is someone to pay me every month? Like, that's truly all I want. And so that I shift my whole focus. I started performing due diligence on the homeowner and understanding their ability to pay, where they're at, in addition to the property.
That's I'm glad you made that point, because the emphasis, and again, a lot of times in real estate investing, you're thinking location and how much rent you can get for it. But, you stick the wrong tenant in there, the one that signs up first, and, the first one with cash, you may find out in a hurry the landlord tenant laws and how long it'll be before you see your money, kind of thing.
Yes.
So yeah, underwriting the tenant, underwriting the borrower, the tenant is really key to success in real estate, period. And that's why, banks and insurance companies have so much, invested in underwriting, is trying to understand what they have, to make it all work. So definitely a
Yeah.
good point.
And what's interesting, and we do everything from an underwriting perspective, everything that a bank would do. So we're looking at property valuations, pulling broker price opinions. We obviously can't go in the home. We're not legally allowed to. We pull O&E reports, title reports. So we're looking at lien validity, lien positioning, ownership. We're looking at property tax records, bankruptcy searches, credit report pulling and analysis, skip tracing. I mean, on and on. And we triangulate data and we make determinations and cash on cash projections. So we're very sophisticated in that regard. But at the end of the day, you're really going to get what you focus on, and that's just from a sourcing perspective too, not just due diligence. So our whole world is sourcing pools of mortgages that have equity coverage, where we believe we can work with the homeowner, and then so we build relationships with other hedge funds that are aligned with that, and that we can be downstream from them and receive deal flow. And then so once we massage those relationships over the course of years, which we've done, then we receive opportunities, and then we run it through due diligence to really make the determination, can we get this borrower to the table so we can do a payment arrangement?
Right. Well, and it just occurred to me as you were describing what you do there. Um, you're buying a blind pool, aren't you? When you get this from one of your other hedge funds, do they say, okay, we got a tranche of, 20 million or whatever the number is, you want it or whatever? And at that point, do you get a chance to underwrite that list, or is it, how much upfront due diligence opportunity do you have?
So it's in due diligence runs in two phases for the most part. So you have you get an initial snapshot of the opportunity in Excel file, and you get to run due diligence and then put in an initial bid. And if that initial bid's accepted, you'll put some stipulations on there to run further due diligence. So in commercial world, a study period, if you will. And so then you can go into deep dive. And then through going into deep dive on, let's say, 50 mortgages, then you might find that a few are not, the liens aren't valid. You might find the fair market values were way off on what was projected. And then you might price adjust some of the notes. But you have to be careful that you're not being a nuisance to the seller, and you're not kicking things arbitrarily or just trying to manipulate the situation, because you'll get blacklisted at the end of the day. So you want to kind of be delicate about how you take that back and forth. approach.
Yeah, no, that's similar in the, you know, real estate acquisition mode. You make the offer, you get accepted, then you have your due diligence period, and you're trying to confirm all the information you thought to be. And I think is it considered a retrade? I know that's the word they use in commercial real estate. If you come back and you're trying to say, hey, wait a minute, I thought it was this. It's got all these things. We need a credit or a discount
Yeah.
for that. I'm assuming if it's legitimate, if you can say, wait, you know, we like the deal, we like the package, but these things were not disclosed. We never dealt with these before. These are issues that we need some credit for. Is that, if it's legitimate, is it pretty well understood?
So it is. So, but here's the thing is this is where our competitive advantage comes into place. We have long-term relationships with very large hedge funds, and they trust us. So when they have a deal, most of our trades are negotiated trades. So they're coming to us and we're just negotiating against ourselves, really, right? It's for us to lose. And so these aren't out in the open market with 20, 30 bidders. So with that said, you know, we have to be real delicate with that relationship. And what we've learned over the course of time is we've learned to manage defects in the mortgage notes. So we know we'll call it out. We'll call out, you know, hey, it's missing this piece of collateral. It's missing the original note. It's missing, you know, the fair market value skewed here. But we also understand our internal systems to be able to overcome certain obstacles. Whereas other hedge funds may just kick that paper. They may just kick that note here and there, and then where you're not creating that relationship with the seller.
Got it. Is there any kind of a timeline to perform once the offer is made? I mean, if somebody says, hey, Martin, we've got this, and you take a look and say, yeah, we're interested, and then you're in your study period, is there a time? Is it weeks, months? What's the typical on that to close a
So
deal?
like any transaction, the seller wants to close immediately and the buyer wants as long of a period as time. Typical trade, you know, 50, 100 mortgage notes, you're looking at a good month to get through the whole process. But what I would say is we do everything. Our other competitive advantage is we like to be speedy to closing. So we have a whole acquisitions team that that does these individuals do other functions in the company. But when we have a trade in hand, they all come together and form an acquisitions team. And we do that because we take an assembly line approach to running due diligence so that we can get through it promptly and get back to the seller and get them paid and closed out. Because what we have found is we've lost opportunities because of time. So whereas most buyers want more time because they want to truly understand, and I get that, we've had loans that paid off before we closed, so we never got kicked out of the pool. You know, we've had other kinds of whatever happened, you know, and trades got pulled. So we want to rush it to closing, but know what we're buying before we buy.
Right. Well, your history and your performance sounds like it speaks volumes to you know, the other hedge funds that you buy from. So, you know, kudos to you and your team. And you know, like anything, I think that the relationship of one that can perform, you know, that history there carries a lot of weight, and you know, you're going to get additional opportunities the more you do that. Prove that you are an option in the marketplace. So I get it. I get it.
Yeah, it's worked out, but like anything else, you know, I found a spiritual relationship with a higher power, 2013. So I kind of always stay humble, and what that's helped me do is it's helped me not settle. So it's not even though the relationships are there, I'm not waiting for the bat phone to ring. And so we're always aggressively looking at new asset classes, looking at connecting with new hedge funds that could be trading partners, and we're not just kind of settling for where we're at.
Yeah, I got it. Got it. Hey, Martin, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with risk. It sounds like you probably do a lot of that yourself
Oh yeah.
in your business. Um, there's three strategies that we typically present as options. The first is we look to see, can we avoid the risk? When that's not an option, we look to see if there's a way to minimize the risk. And then the third option is, can we transfer the risk? And we transfer it to an insurance company, an insurance policy. That's what it is. It's a risk transfer vehicle. So I like to ask my guests if they can look at their own situation. Could be their clients, the borrowers, the market, hedge funds, however you want to frame that. But if you could take a look at your situation and identify what you consider to be the biggest risk. And for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. So if you're willing, I'd like to ask you, Martin Saenz, what is the biggest risk?
I would say compliance, being out of compliance. So missing something in the due diligence process, such as you buy a loan that's outside the statute of limitation, and you begin legal activity on that loan, then you could be held liable as an organization. So there's a risk that way. Property, the collateral, right? That's it. That's really what's backing the obligation at the end of the day. So not having forced place insurance on a senior lien mortgage note and the house burns down, then you're not going to get paid. You need forced place insurance. Errors and omissions from an insurance perspective. There's so much. We say paper, but this paper is full of words that are written by attorneys, and there's a lot of those pages. So just making sure that all the promissory note, all the collateral files have been signed and initialed by the borrowers, and whereby they're validating that debt to be there in existence. And so I would say some of those, and then licensing too. I mean, you have to have certain licensing to operate in certain states. So if you're operating out of compliance from a licensing perspective, then you can have a state regulatory body come down on you with fines, and they could prohibit you from operating in that state.
Yep. No, compliance is a big deal. And especially when you're working across multiple states, you find out that they're not all the same, right?
Oh
So,
gosh, yeah.
yeah, that's
Yeah.
great.
And that's why, like, whether it's BeQuest or it's a syndication, a REIT, something that's out there, you have other guests on that have other opportunities. That's what I would always want to know as an investor, because I've been an investor for a while, is, what's the risk there with that opportunity? How are the operators licensed? Are they, what's the downside and all that? Very important to know.
Yeah, no, definitely. Martin, where can the listeners go if they'd like to learn more or connect with you?
Sure. Just send me an email, martin@bqfunds.com. And I'll send you the tax treatment document. I'll send you a free ebook. I've written 3 books on the mortgage note industry and 2 other books. So I've written 5 in total. I'll be happy to mail you out a book. I love connecting with people, and it's really a passion for me. Like, same way you're doing this program, you're helping educate people on new ways to invest, how to be better investors. And that I have the same passion. I'm a believer in passive income, cash flow, financial independence, and you have to do that by taking control of your future and educating yourself and being disciplined. So if I can help anyone in any way, whether it's note related or other, let me know.
Awesome. Martin, I can't say thanks enough for taking the time to talk today. I've learned a lot, and hope we can do it again soon.
Thank you, Darren.
All right. For our listeners, if you like this show, please don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.